Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, December the 4th, and I want to take just a brief minute to discuss what equity markets did last week, as Thanksgiving is traditionally a very, very good week in equity markets, and this year was no exception to that. It was a very positive week in the equity markets, with the S&P 500 up 3.73% on the week. The mid-cap index up a little bit higher, up 3.93%, and the small caps as measured by the S&P 600 were the leaders on the week, up 4.52%. And what you are seeing is a month-end recovery to make the month of November be relatively flat for equity markets. And as we moved into this week, everyone wanted to see the results from Black Friday and Cyber Monday, because the narrative going into that was that the consumer was slowing and that the consumer has been stretched as far as they can be stretched, and expect a slow season this year in the retail segment. And if you look at the consumer discretionary sector year to date, it is lagging well behind the S&P 500, barely positive year to date, just hovering barely above zero on a return basis, and that's because there's the belief that the consumer is weak. Well, we got the data in from Cyber Monday and Black Friday. Black Friday and Cyber Monday both set all-time records for total sales on those days. So the consumer, from all the data we're now receiving, is showing resilient, but at the same time we're getting some things that are not necessarily positive things for the economy. So for example, if you look at ADP for the month of November, the private payroll report that was released yesterday, that showed that we lost 32,000 jobs last month. Now, we don't know if that was due to the government shutdown. We don't know what's the cause of that, but year to date, there have been 1.1 million announced layoffs, the most since 2020. So why that's important is we have a big Fed meeting next week, and the Fed is set to meet Tuesday and Wednesday of next week, and it looks like there's a 90% chance that they're going to cut interest rates, is what the predicting markets have, in that because they're playing out their dual mandate. It's not just inflation, it's also the employment side, and they're seeing employment start to weaken, and they're going to lower rates potentially because of that. And so you may see them lower rates by 25 basis points. And now the market expects that. If they do not cut rates next week, expect some volatility on the downside, as again the market doesn't like being thrown curveballs. But what I wanted to also touch on here briefly is what we're seeing technically in the markets, and that's important to us. We don't always rely just on technical analysis. We also look at fundamental analysis. We look at the climate, the macroeconomic picture. We look at a lot of things, but we always focus too on the technical side. And what we're seeing underneath the market from a money flow perspective is a very, very strong market. What we're actually starting to see is a market that may broaden out away from the AI trade to more of your financials, your healthcare, your consumer discretionary names, your industrials. You're going to potentially see some money leave those AI names and move to those other broadening names. The other encouraging thing that we've seen is the small and mid caps have lagged well behind the large caps year to date. And what we're seeing now is those money flows are finally starting to turn positive, which shows that there's some buying pressure now in these smaller names, showing confidence in the economy moving forward, and that they believe interest rates moving down will benefit the smaller companies, as they're more reliant on variable rate debt, and the lower the rates, the lower their debt cost. And so that's why you're seeing rallies there. So we expect there to be just keep a steady hand through this. If there's some volatility through here, the long-term prospects remain very good for the U.S. economy. We have plenty of great things coming down the pike. For example, we're expecting to give back more money than we've given back in many years in tax refunds. It's very stimulative for the U.S. economy. So things like that are coming down the pike in Q1 of 2026, and I can't believe I'm already saying that. But I hope everyone has a wonderful rest of your week. If you have questions about how to navigate this as we head through the holidays and what to expect, give us a call. We'd love the opportunity to speak to you. You can reach us at 904-346-3460. Or as always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Thanks so much for watching.